Howdy, my name is Ben Brown and I work in the College of Food, Agriculture, and Environmental Sciences at The Ohio State University, and this is my market outlook for the week of May 1st, 2020. The theme for this week's outlook is related to the Cattle on Feed report that came out from the United States Department of Agriculture last week. This report is important for both producers and consumers as it gives us an indication of the demand for live animals from the producers, as well as an indication of future supply of beef as these live animals get turned into fat cattle. We'll dive into the numbers and look at the prospects for both the third and fourth quarter of the marketing year. I first just want to start by summarizing the Cattle on Feed report. Cattle and calves on feed for feedlots of 1,000 head or more totaled almost 11.3 million head to start the month of April. This was really close to expectations, but still down 5% year over year, down 4% from the previous month. The graph to the left there illustrates monthly cattle on feed for 2019 and 2020, but I especially want to bring attention to the 5-year average, represented by the black dotted line, showcasing just how much we've grown the beef industry in the last 5 years during this cattle expansion cycle. The most anticipated part of this report was the March net placements. March placements were expected to be drastically down, foreshadowed by weak local auction prices and daily slaughter reports, which we'll talk about here in just a second. But new placements for March came in just over 1.5 million head of cattle. That's down 23% from the prior year and is the lowest March placement value since 1996 when the reporting started. Now this number by itself would be pretty bullish if we're looking for a positive. If we didn't have everything else going on, less placements now would mean more competition for fat cattle later in the year, and that would drive price discovery, especially considering that we're following a pretty weak month in the month prior. But I also think we could follow that with another weak month of placements, unfortunately, here in the near term. That's where we look at the incentive for feedlots to buy cattle. And Glenn Tonzer at Kansas State University updates this report monthly, basically showcasing the incentive for feed operators or their margins to go out and bid on cattle. And the year started off strong, but it continued to decline through February and March, and has continued in April. And so I expect another month of weak placements, and it's continuing. I mean, we're continuing to see weak local auction sales. When we look at Kentucky auctions, which is our closest market that we have reported data for, they've declined for both, the heavier weight cattle and the lighter weight cattle, but they've kind of stabilized over the last 2 weeks. We did see a nice bump 2 weeks ago in the Cowcalf market, and that stabilized again this week, so that's a good sign too. But short story is, until feeder margins, improve, we're going to continue to see weak cattle placements on feed in the next couple of weeks and potentially the next month or two. I think for a lot of us in the ag industry, we continue to follow the daily slaughter rates, hoping to see some improvement. I just talked about how until we see some improvements at the margin for our feeders, we aren't going to see much support for our feeder cattle at our local auctions. And I think it's represented nicely here in this chart, which I'm showing a 6-day moving average of cattle slaughter, to somewhat take into account weekend runs and holidays, but you can clearly see the 33% decline in daily slaughter rates from just our peak a couple of weeks ago. Feeder operators aren't going to feel too comfortable buying cattle until we start improving slaughter rates above 78,000 head a day. The other thing I find interesting about this graph is the buildup right before the crash, as a lot of these packers were giving premiums to pull cattle forward. It created, we marketed just over 2 million head. It's the second largest March marketing since the reports began in 1996, which just further, exemplifies the challenge at the feeder level as well, given that we had, second highest marketings since 96, but we also had the lowest placement ratings on feed since 96. Switching to Cowcalf Operations for just a second, they've traditionally had an economic decision between a cost of gain and the value of gain. Basically, the decision to keep an animal longer and sell at higher weights, or to sell at a lighter weight. Usually, this is an easy decision. If the value of gain is bigger than your cost of gain, you're making money. If it's the other way around, you're losing money and you should sell earlier. The difference now is that decision is being made for our producers. There isn't anywhere to go with their product, and so they have to keep it on the farm, and a lot of them are finding themselves in an unusual situation to where they're not used to feeding or finding ways to keep those animals on farm. So we're going to have some challenges there. My recommendation would be to find ways to add gains at low prices or low cost. And that relationship with your lender is going to be important as we go forward. And then finally, I just want to mention, because we talk a lot about the availability of meat. We were in a decent situation going into this. We had just over 500 million pounds of beef in cold storage. That's the first time we've eclipsed 500 million in 13 months. And so we'd been growing our cold storage. I'll just remind everybody we consume about 2 billion pounds of meat per month, so we've only got a quarter of what we would consume in a month. But again, I'll say this, we are still slaughtering cattle, albeit at a slower rate. We're still slaughtering cattle, and we've got that cold storage there too. The second thing that I've been hearing in the news is related to export markets and limiting our exports to keep more of that here domestically. I just remind folks that some of those parts of our cattle that we don't consume here domestically, we are able to find value in those in international markets. They're willing to pay for those, and so that's providing value for that cattle, and it's also providing competition for the product. And as long as there's competition for the product, our packers have an incentive to remain open. So my fear is if we started cutting down export channels without the really strong need for domestic meat, we'd actually be sending an economic signal to our packers to remain in this slowed environment, or not full capacity. The economic incentive, at least, is there when we're competing for products and bidding the price up. Is that creates the incentive for those packers to continue to go. That creates margins for our feeders, and then that trickles down to our cow-calf operators as well. And with that, I would just like to say that there's large uncertainties that remain in the agriculture industry. And as we move through 2020, a lot of these demand issues related to buying power, the availability of meat, are going to influence the placements of cattle, the ability to buy cattle at local auctions, and then also the growth in cow-calf herd operations as we work our way down through the cycle. I'd like to thank you for attending this webinar. As always, you can find more information about our weekly outlooks at farmoffice.osu.edu, and we look forward to seeing you around the state of Ohio soon. Thanks.